How would you react if I told you that semiconductors are poised to play a pivotal role in the future, and there's a company in focus that delves into the intricate world of Internet of Things, IoT, and industrial and mobile communication services? Today, let's delve into the realm of NXP Semiconductors, a Dutch company operating out of the Netherlands. They're making waves in the automotive, industrial, and IoT markets, designing chips that cater to the evolving needs of these industries. Now, before we dive into the nitty-gritty details, have you ever wondered about the dynamics of semiconductor companies, especially those dealing with IoT applications and industrial solutions? What makes NXP stand out in a sea of competitors like Qualcomm, Nvidia, and AMD? Let's dissect the layers of this semiconductor giant and understand its positioning in the market. NXP Semiconductors positions itself as a key player in providing secure connectivity solutions for embedded applications, catering to the automotive, industrial, and IoT markets. Unlike some of its competitors that focus on GPU and CPU, NXP zeroes in on designing chips specifically for automotive, industrial, and mobile applications. This strategic focus has pitted them against industry heavyweights, and today, we'll analyze their financial health, growth, and profitability, efficiency, and valuation to understand if they're a solid investment. Before we go any further, I'd like to hear from everyday Americans. What are your thoughts on investing in semiconductor companies, especially those involved in IoT and industrial applications? Drop a comment and let's start a conversation. Now, let's dive into the quantitative analysis. NXP has been making strides in terms of revenue growth, with just under 12% expansion. Gross profit has seen a commendable increase of 14.7%, and key margin indicators like EBITDA and net income have witnessed significant growth. However, there's a nuanced concern regarding stock-based compensation, which has risen by 17%. It's crucial to consider how this might impact the overall financial health of the company. Balancing on the edge, NXP's balance sheet raises a few eyebrows. While they boast strong current and quick ratios, the debt-to-free cash flow ratio is slightly over 4, tipping the scales. With over $11 billion in debt, it's a concern, despite the growing cash reserves. The percentage of goodwill to total assets is alarmingly high at 48%, far exceeding the preferred 10%. This could be a red flag for investors, indicating potential overvaluation in the balance sheet. Now, let's shift our focus to the valuation metrics. NXP appears to be trading at reasonable multiples, with a price-to-earnings ratio of 17 and an earnings yield of almost 6%. Price-to-sales, price-to-free cash flow, and enterprise value to free cash flow ratios also seem to be in check. But what do you think about these metrics? Are they convincing enough for you to consider NXP as a viable investment option? Efficiency metrics, such as revenue and net income per employee, indicate positive trends. The company has more than doubled its revenue per employee since 2013, showcasing increased productivity. However, it's essential to scrutinize whether these efficiency gains are sustainable in the long run. Now, let's crunch the numbers. NXP is expected to grow at a compound annual rate of 10%, with revenue set to expand by almost 8%. While these projections seem promising, it's crucial to factor in the industry's dynamics and anticipate potential margin expansions. Investing in NXP should be a strategic move aligned with the expected growth in the demand for semiconductors, especially in automotive, industrial, and IoT sectors. Before we conclude, let's circle back to the valuation models. The discounted earnings multiple model suggests an intrinsic value range of $155 to $175 per share, taking into account growth projections, discount rates, and margin of safety. On the other hand, the discounted cash flow model paints a more optimistic picture, hinting at potential undervaluation. Considering all these aspects, it's essential to tread carefully when evaluating NXP Semiconductors as an investment. The support level at $145 seems critical, acting as a buffer against potential downside risks. However, the lower, the better, right? Now, as we wrap up, think about how NXP's financial health, efficiency, and growth prospects may influence the demand and pricing of its stock. What's your take on the future of semiconductor companies? And would you consider NXP in your investment portfolio? Disclaimer: the analysis presented here is based on publicly available information and does not constitute financial advice. Always conduct thorough research and consult with financial professionals before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.